Hi, my name is Bruce Bolger, and I'm founder of the Enterprise Engagement Alliance, and we're an organization dedicated to helping organizations implement the process of enhancing returns for investors only by creating value for customers, employees, supply chain and distribution partners, communities, and the environment. And we're here today to discuss a really critical issue, and I'm having a little technical problem here in that I don't think my slides are available, so I'm just going to ignore that and move on. Again, we offer a lot of free information at the Enterprise Engagement Alliance, so check out our website. We're really here to help companies put the practices of stakeholder management to work. So we're very lucky today to have two individuals who are really at the forefront of this movement. We've been lucky before to have Bart Houlihan, who's really one of the co-founders of B Lab, but he's now working for Irrational Capital, helping develop tools that companies can use to better benchmark their own performance. And David Van Adelsberg, and David, the V is uppercase. Oh my gosh, we ruined it. Oh,
That's it.
it should be a lowercase v, folks.
It's all good.
And I betrayed my failure to my Dutch heritage. So David is one of the founders of Irrational Capital, and they have developed, and we're going to hear about it, a whole set of metrics of people performance that are directly related to the stock performance over time. And that, of course, is the index that Bart uses for his work. So, gentlemen, I'm going to skip any other. I assume the slide isn't showing, right, folks? Can you bear with
It
me?
is,
Right,
it is slow.
It's
It is
showing,
slow.
Bruce. You still see
it
your
is
slide.
showing.
Yeah.
Yep,
Well, it ain't now.
Yeah.
perfect.
So anyway, David, I'd like to start with you since you are really one of the co-founders. What made you decide to start Irrational Capital? And I'd love to hear the quick story of how you called something so rational irrational.
Yeah. It's a story of, I mean, I think it's a story, fair to say, of dumb luck over skill. Um, the I approached Dan Ariely, the well-known behavioral economist, now going on a little more than 7 years ago, with a pretty simple concept. Dan had been studying human motivation in the workplace for many years, but doing it in small configurations. And I said to him, look, every manager I've come across, and he agreed, every manager he had come across, says something to the effect of people are our most important asset, most important and an asset. And I said, do you think it might be possible to see if we could expand the kind of work that you've done to the ultimate to measure the ultimate measure of performance, that being a company's stock price, based on the way in which employees are treated and the perception of employees are treated by their employer. And Dan was excited to say yes, which was delightful. A little bit of the proverbial dog catching the car was like, now what? We were able to gather some very interesting proprietary data. When we sent that data to some experts, there was clearly signal alpha in what we had in what we had shared with them, and then we were off to the races. And a little over a year ago, we were very fortunate to run into Bart again. And so Dan, Bart, and I are partners in this business, and it's been a very exciting ride. And I think we've made a fair amount of progress in being able to assess the nature of the relationship, and as a result, being able. Whoops.
He froze, I think. So
So
my
we'll continue. Should we continue
we
on?
should continue, assuming he's going to rejoin.
Perfect.
I think we're still live.
Great. So why don't I share my screen for a minute, and I'll tell you a little bit about the Genesis story, and sort of what we've discovered, and then hopefully Bruce will be back and we can continue on. Does that make?
Otherwise, David, you and I can have a great conversation.
We always do. We always do. So hold on one second, and I'll share my screen here for a second. So, it's not a revelation that people are our most important asset. Here are some luminaries that say it. Basically, every manager, that's really good at what they do, from the front line to the boardroom, says something to the same effect. But traditionally, human capital isn't easy to measure. And it's certainly not accounted for as an asset. It's, it sits on the income statement as a liability, as an expense. So the result is that our view was that human capital was systematically overlooked and mispriced. Um, and so we sought to understand human capital at a very deep level and to see if it was predictive of future equity performance. As I mentioned, the ultimate measure of performance, a pub company's stock price, future equity performance. And this has all been codified into a new investment factor. And for those that are listening, you know that new investment factors don't come along very often. This is not our language, but actually JP Morgan has published, their quant research team has published 4 very detailed research reports to confirm and validate in an independent way that the human capital factor actually is an alpha generating factor. Everything starts and ends with data. We have an extensive data set, which we've built over many years, much bigger than when we started. We fuse proprietary data and public data on the perception of employees together. It's long-standing, in some cases goes back to 2006 trading year, 2005 data collection. It's highly stable, meaning the same questions are asked year after year after year. And our coverage, therefore, is very good. You can see the percentages of the major indexes. And again, JP Morgan has looked at this in great detail and says very favorable things. Question is, when you lift the hood, what have you discovered? What did we really find? And what we found is that the results bifurcate into what social scientists call motivational characteristics, and there are 2, intrinsic and extrinsic. Extrinsic being things that are external, and in this context, you can see on the left side, it's the normal, usual suspects: levels of compensation, quantum of benefits, number of training hours, number of people in a cohort, and so on. And as you can see, this column on the far right is best versus worst over a 10-year period, financial performance, equity performance of the companies that we have this information for. And this signal of the usual suspects is pretty muted. But when you look at the intrinsic characteristics, those are things that are very personal, emotional, deeply important to us as humans, right? And those are things like a level of trust, or is the organization transparent? Do I feel appreciated? What's my sense of going in the right direction? There's a very strong signal. Now, we use an organizing framework of 7 dimensions, and you can see the best versus worst performance. This is on an annualized basis against these 6 characteristics, which are intrinsic motivational elements. So we use all of this data, and I'll just give you one example, and then Bart, maybe you want to chat about what motivated you to join us, and how this all came about from your perspective. But this is an example of the top 100 and equal again. This is equal weighted versus an equal weighted S&P benchmark. So top 100 all the way back to 2006. This is work that was actually done by JP Morgan against our signal. Annualized returns of greater than 5%. And so there is alpha in these hills, which is basically a confirmation that managers are correct. People are, certainly a very important asset. So let me leave it there. And it's from this work that we build investment strategies, and the human capital factor can be used in lots of ways. In partnership with Harbor Capital, there are 3 publicly traded ETFs on the New York Stock Exchange. We offer our signal to a very select group of asset managers, and then Bart is building a very interesting business to enable companies to have access as well. So I'll stop sharing, and Bart, maybe you want to pick up from there.
Yeah, so here's my suggestion, knowing that Bruce, I think his internet crashed. I'm going to play Bruce for a little bit and ask you a couple of questions, David, and then we'll invert it here, and I'll happily tell a little bit of my story. And so the first question that I know I get when I present this is, why haven't other people found this alpha? Like this is not a new idea, right? That people drive performance financial and stock price, but nobody, as far as I know, has ever found this connection. Why haven't others found this connection?
It's a really good question. I'll tell you why I think it is the case. Whether this is in fact the reason why or not, I can't be 100% sure. But the data is really hard to come by, right? I mean, trying to find deep and rich data that goes back a long way and that's hugely stable, it's not that readily available. If you look at the publicly available data, it's been collected for a handful of years, call it 5, 6, 7 years. You want to go back further than that. And so access to the data is a big piece. The other thing is that generally human capital data has been largely compared to itself, right? We look at the performance of our employee surveys and these kinds of things, one year against another year, one team against a division or against a department or against the entire company or everybody in the industry or everybody who's ever taken the survey. And I think our innovation in this is that we are actually looking at the relationship between this information and future equity performance. And the beauty of that is there's no financial data in anything we're doing. So there's no way to sniff the line or overfit or data mine. When you're looking historically in this way. And so it's a very exciting new approach to taking data which exists and applying it in a different way. Why someone else hasn't figured this out. I mean, the math's not particularly easy, but it's relatively straightforward. And I think that we sit at a very interesting nexus of having backgrounds in technology, in human capital, and in the financial services world. And it's the center of those three circles that have sort of converged for us.
And so there was something you said there that I want to make sure our audience heard. And I'm just going to frame it as a question. What other data does the company use outside of employee sentiment data to make these portfolio selections?
There is no other data. It is 100% the perception of employees through survey data that is used to create the human capital factor. So there's no financial information, no ratios, no growth, no EPS, no debt. We're looking purely at the perception of employees in a prior year, looking at that and how that is predictive in a subsequent year. And so that's it's a bit of the simplicity of what we're doing. And I think it's also the fact that this data is complex in its nature, right? For example, if we wanted to know how company X, large company X in the industrials business, how employees felt about it 3 years ago and 2 years ago and 1 year ago and 4 years ago, so that we could we could do some modeling around that. Unless you have that data, that's not something that's easily replicable.
And so, David, I get asked all the time, and I'd love your answer on this. Based upon when Irrational Capital's funds launched, this feels like a technology play, that you've timed it right with the transition to the information economy. And, those information companies have always treated their people extraordinarily well. Isn't this just a reflection of a technology?
Isn't it just that happy companies, like companies that are doing better, have happier people, right? So it's a reverse of that. Yeah, the answer to that question is look, there may be a little bit of that in there, but no. The truth of the matter is what we see is that when companies get it right from an emotional perspective, from a relationship perspective, it is predictive of their future, of their future value. And just to go back to the technical point, the technology point, and I think this is very interesting. Last year, for example, the ETF, the flagship ETF, And we're not the ETF issuer, so we don't talk about them, but there, you can find them. Harbor Capital is the issuer. But the underlying index of that, which is the CIBC Human Capital Factor Index, outperformed materially by over 400 basis points. 80% of that performance was not related to the Mag 7. I'm going to say it one more time because it's really important. 80% of the outperformance was not related to the Mag 7 in a year where, I don't have off the top of my head exactly what it was, but a majority of the outperformance of the S&P was related to those 7 stocks. So we found something, and this is not just us, whistling our tune. This is, independent validation that the selection effect of the human capital factor is very effective.
Independent of industry.
Interestingly, like originally when Dan and I started, we were like, oh, companies with large cadres of employees who do this well, that's going to be that's going to be much better than, so we thought that consumer discretionary, financial services, tech is going to do much better than industrials, real estate, and energy. And it's not the case, because going back to those characteristics that we looked at a few minutes ago, these human characteristics, a sense of pride, feeling appreciated, is true of someone who works at John Deere, or somebody who works at Morgan Stanley, or somebody who works at Meta, or somebody who works at Exxon, right? Pride is pride, appreciation is appreciation. And so there are very small differences, but stunningly small. And that was quite a revelation for us when we first started.
In your slides, you mentioned a relationship with JP Morgan, and I didn't quite understand. Can you talk a little bit more about the company's relationship with JP Morgan?
Yeah. So, goodness, it must be now in 2001. We had the good fortune of meeting the head of the quant research team for JP Morgan, who was very interested in this subject. And as a result, asked to do an evaluation of the signal, which we were, of course, delighted about. And they published an initial, I don't know if I'm going to get this wrong, but something over 35 page, 40 page, detailed analysis and research report, what they call a research note, called Introducing the Human Capital Factor, which, by the way, if anybody's interested in, we're happy. You can go to our website, which is irrational.capital, and we're happy. You can just put your information in and you automatically get the report. They have published 3 subsequent reports, so 4 in total. It's not, that's I think, rather unusual thing for an emerging company like ours. But it creates amazing independent validation that the signal is providing what we intended it to, and this very and by the way, JP Morgan's quant research team is considered to be the #1 research team according to II. So we think it's a pretty nice point of validation.
And with regards to the signal, with regards to the alpha, the other question I get all the time when I'm out talking about this is, this has to be a momentum play. Like, how does this signal, how does the factor correlate with the other factors that are in the marketplace?
Yeah, it's a great question. And we do get it all the time. And the answer is that was another one of these moments, right? The industry piece and the correlation. Like, we thought maybe it's just a repackaging of, quality and momentum, but it's not. And I won't go into all the details in this forum, but in those JP Morgan reports, or we can send something else. The answer is it is not highly correlated. It is a factor, and the selection effect is significant in and of itself. So it is orthogonal to the standard available investment factors, which were available at the time and is now added. And I think you'll see, there's more to come on sort of the accessibility of access to seeing how the human capital factor plays out.
Super helpful. Last question, and then we'll flip this, which
Yeah.
is, this looks like ESG. Like, is this ESG? Is that what you guys are doing? You know, and how does it relate to ESG?
Yeah, it's also a great question. The answer is our view was this is most important asset. So it's about the generation of alpha. Now, obviously, treating people well has is socially redeemable. So folks are interested, those folks who are interested in putting us in a particular category from that perspective, we're delighted. But as you know, Bart, we often say, we're bipartisan on this subject, right? We lead with alpha, right? If it's not creating a return, then it's very difficult to continue to invest. So that's primary. That is, that's one, two, and three basically. But the fact that the underlying signal is about treating employees with respect and well and being able to measure that, that has, obviously, it can fit into that category if, for those who, find it very interesting.
Super helpful. And so here's my recommendation, my friend. What I'll do is I'll give kind of like a quick overview of my story.
Yeah,
And
please.
then we'll invert this and let you ask me a few questions.
That would be great.
And we'll go from there.
Yeah.
And so I'm the newcomer, friends, to Irrational Capital. I've only been with the company for a year. And interestingly, I am not an investment professional. So I'm also, it's a new industry for me. My background is as an entrepreneur. I ran an athletic footwear and apparel company back in the late 90s and early 2000s, a company called And One Basketball. At its peak, it was the second largest basketball company in the world. We scaled it up to about $250 million with distribution in over 80 countries. We had 82 NBA players in our product. We had an entertainment division called the N1 Mixtape that became quite popular. And believe it or not, we built that business to really have purpose at its center. We were a bunch of friends from college who all came together to build this business, and we wanted to build something we were proud of. And for us, that meant putting our people first and how we behaved. And what we saw over our 11 years was that wasn't just the right thing to do, it was a better way to do business. Time and time again, we saw that putting our people first created a competitive advantage for this company competing with Nike and Adidas and Reebok. Fast forward to 2005 when we sold the company. And let's just say the gentleman who bought the company didn't share those values. He didn't share the ethos of putting your people first. And the company collapsed. It went from 250 million to 40 million in revenues over 3 years' time. And looking back on that, it felt like there just had to be a better way. There had to be a way that we could prove at scale that putting your people first was a better way to do business. And that brought me to co-founding a nonprofit, something called B Lab. It is the nonprofit behind the B Corporation certification. And for our listeners who don't know what a B Corp is, the easiest way to think about it, it's like a good housekeeping seal of approval for a good business, a company that takes care of its people, measures and manages its environmental footprint, is in and of a local community, and is trying to drive value for all of its stakeholders, not just its shareholders. That certification, there are now closing in on 10,000 certified B corporations in 102 countries, 150 different industries. They range from Danone and Paris, the dairy giant, down to sole proprietors. And the commonality is they're all putting their people first. And my job at B Lab was to demonstrate not only was there real appetite for running a business this way, putting your people first, but also that we had data that showed it was a better way to do business. And so we collected data that clearly showed that revenues grew, that attrition rates were lower, that retention rates were higher. And the data point that I was most proud of was we also showed that these companies were more resilient during the global pandemic, when as many as 1 in 3 small and medium-sized businesses failed across the globe, our community had an attrition rate of around 5%. They just wildly outperformed traditional businesses. And if you ask the leaders, like, why? They'd say it wasn't in spite of putting their people first, it was because of it. It just made them able to withstand the variability of the marketplace. I stepped down from that about 2 years ago because it was time. There was 500 people, David, across the organization, and that's about the end of my skill set. And I ran into David after a year of consulting, and you can imagine how I was immediately intrigued by this idea that he had independently verified statistical evidence that putting your people first resulted in outperformance in the equity markets. And what I was particularly interested in was they clearly had an ETF business that David's already talked to you about that was up and thriving and doing well. What I wanted to explore with the company is how you can take this idea and bring it to individual businesses so that they too can get the benefit from running their organization with their people first and see equity value creation as a result. And the idea that David and I have been working on, and we're now in a soft launch, it's still very early days, is launching a rating system where we rate individual companies on their human capital factor. And so we can give them that data by division, geography, by peer group. We can look at it by gender, by seniority, by tenure. And David already mentioned, like, what is profound about the ratings is they're not self-referential. You're not comparing your performance this year against last year. And I don't want to denigrate that. That's super important. Measuring well-being and attrition and retention, those are all really important efforts. But what distinguishes this rating is it's benchmarked against the 4,000 existing data companies that we have in our data set. And so you can see how you rate compared to others in your geography, size, industry. And then we give you actionable insights. We'll give you essentially a heat map of not only areas where you're excelling, where your human capital is directly aligned with creating equity value in the future, but also those areas where there are specific opportunities for improvement. And we do it by the 7 dimensions. You saw on a slide that David presented those dimensions that are directly correlated with outperformance in the market: organizational effectiveness, emotional connection, innovation. There were 7 that were listed up there. We'll give you the rating by those 7 dimensions, also by division. So you can say, oh goodness, I got a problem in my San Francisco office with women around emotional connection. And so it will isolate and identify those areas for the company to work on and take actionable next steps to try to improve that human capital and align it with what, frankly, is still what most C-suites care about, which is equity value creation and stock performance. And so that's what I'm up to, and that's why I joined Irrational Capital now about a year ago.
Amazing. So Bart, look, I think we only have a minute left, so I'm just going to ask you a 2-part question here. You're a CEO of a large public company or a thriving, private company. Just give us, like, what am I going to get that I can't get anywhere else as a result of going through this process?
Yeah, great question. And so this is complementary to the work you might already be doing with employee listening practices, where you're bringing in information about attrition and retention and well-being. We are not focused on that at all. We are optimizing for one outcome: equity value creation, and how your corporate culture is specifically aligned or not aligned with equity value creation. And so you'll receive, David, a 30-page report that will give you deep details about where you have challenges, where there's a misalignment between what your employees perceive about the organization and whether you're going to drive ongoing outperformance in the equity markets. And that's what makes this different, and that we're not trying to compete with the culture amps and the Gallups of the world. They have an important role to play. We are focused on one thing: the ultimate metric, which is stock performance.
Got it. That's amazing. Let's do this because I think we have to end. If folks want to learn more about what you're up to, how do they get in touch?
Yeah, so first, you're welcome to connect with me on LinkedIn, and you can find David on LinkedIn as well. And on top of that, go to our website, irrational.capital, as David mentioned, but on there also is a sample ratings report. It'll give you a really quick idea of exactly what we're generating with the data that we're pulling and how it would end up providing real insights for you to operate in a different manner.
Perfect. Bart, it's always great to be with you. It was fun being with
With Bruce.
for a short period of time. Hopefully, we've done what he was hoping that we would do, or we'll come back and do something different another time.
Indeed.
But anyway, it's lovely to be with you. Thanks everybody for watching, and hopefully we'll be in touch.
Thanks, everybody.
Bye now.